For a long, long time, if I asked an investor a question, are you being compensated for the risk you assume in credit? They would say no, but we're there because there is no alternative. At some point, that stops. When you look at the breakdown in high yield, does it make you worried, Russ?
Well, at the very least, it makes it less attractive. You know, we've been pulling back on our U.S. credit exposure in the global allocation fund, not because we think there's an imminent disaster, but because that risk reward is no longer as attractive. Now, the key is you start to see rise in defaults, a rise in restructurings to tell you this is not just not as attractive, yields are lower than you'd like, but something's actually going on there. The 800-pound gorilla, which eventually we're all going to have to question, is whether or not this buildup in corporate leverage, which we've seen over the past 3 or 4 years, is that sustainable, or does that lead to something less benign?
And what are your thoughts right now?
Well, I think right now we're probably not at the point where I'd panic, but it's something that if it continues, it makes me question the equity rally a bit more than I am right now.
Do you think the supply story has started to bite as well? We have sucked up supply in this market in a massive, massive way, more specifically on the investment grade side of things too. Is that starting to come through?
You know, at some point it will. I don't know if we're there yet. You know, the thing that I hear again and again is this insatiable thirst for yield. And you think about the bond market today versus pre-crisis, the number of fixed income securities that yield more than 4% is less than 1 in 5. That number used to be 100%. So if you're an individual investor, you're looking for a reasonable mid-single-digit yield, there are not many places to go, and that's why that demand keeps coming through.
Russ, let's get back to that chart, because I think it's really important. You're a multi-asset strategist, and I imagine a lot of clients are going to call you up and say, Russ, credit's breaking down. What do I do with my equity positions? Do I hang in here? If we get pullbacks, how do I behave? What's the best approach? What is the best approach?
I think the best approach is you keep watching the credit market. Right now, you're at a point where you can only really get to this valuation if you believe we're in an environment in which rates stay low, credit market conditions stay benign, volatility stays low. If credit market starts to break down even modestly, I don't think volatility remains that low, which means the valuations in the market probably have to come in a bit. Doesn't mean a bear market, but it does mean your risk of a correction has gone up.
Why isn't this a buy the dip day?
I think it's not a buy the dip day, partly because you see a very extended market. You see some very crowded trades. Again, it doesn't mean this is a bear market or even a 10% correction, but it does mean we've gone a very long time with very low volatility. You know, for example, if you look at bond market volatility, you're now close to a record low.
Yeah.
That's normally the case where you're a little less inclined to buy the dip, at least in the short term.
How do you fold in the flat Treasury yield curve into this discussion that we've just had over the last couple of minutes?
I think the flat Treasury yield curve is a function of a couple of things. One, of low yields overseas. Yes, bond yields have backed up a bit, but they're still very low relative to the U.S. I think it's evidence of some skepticism about the ability of tax reform or tax cuts to accelerate the economy. And I think it still reflects the fact that despite all, a very tight labor market, there's still very little evidence of accelerating inflation in the U.S.